Glad to know you're still with us. A plummeting naira, skyrocketing inflation, and a lack of clear direction from policymakers. All these we have described Nigeria in the past few months. But analysts at Goldman Sachs are saying a glimmer of hope, a significant shift in monetary policy. Has Nigeria truly turned the corner? Well, joining me to answer this question is Oladipo Ajayi, Head of Fixed Income and Forex at Chapel Hill Denham Securities. Thank you, Oladipo Ajayi, for joining me today.
Good morning. Thank you very much for having me.
All right, so this is a report from Goldman Sachs, and I would like us to begin with, the very first statement, if you open that particular report. And I know you have also talked about negative real interest rates during some of our previous conversations. It's something you've talked about over and over again. So I'm not going to bet, I'm just going to bet that you agree with this paperwork on that. So let us look at the part where it says the country is emerging from a period of monetary policy transition characterized by an absence of a credible policy anchor. Now, that is the part I want to get your thoughts on. Do you share the same thought? Oladipo Ajayi, if you can hear me, I was asking if you share the same thought with Goldman Sachs on this particular one. I mean, on the one hand, they've talked about how that the interest rate isn't encouraging for investors to come into the country, and that's why we're talking about negative, real interest, real returns, and all of that. And then on the other hand, they're also talking about some of the things they feel, talking about how that, maybe the policy, there was no anchor really for Nigeria's monetary policy before now. And I would like to get your thoughts on that if you can hear me.
Yeah, thank you very much. I so much agree with the report to a great extent. The mention of the fact that Nigeria is moving to moving to a more credible policy, it makes a lot of sense because they are looking at it from the angle that you can't perpetually keep monitoring or keep your rate stagnant while inflation is skyrocketing. You need to actually move rates. And if you also read the report, you will see where they actually mention the fact that for a long time now, the policy rate has become ineffective. And so it simply means that the monetary policy meetings all the while has been more like a tea party. So what they're trying to just highlight there is to state that truly the new CBN governor is actually working his stock. And you mentioned that his policy will be inflation targeting. He mentioned that it will at least move to a more flexible exchange rate compared to a peg exchange rate system where we're coming from. He mentioned, he talked about greater transparency and across board many other things that he actually mentioned. And because of the fact that they're already seeing the impact of what he actually mentioned, and that's one of the reasons why JP Morgan actually mentioned that we are moving to a more credible policy.
All right, so I can almost assume that you're betting on the same metrics as the MPC decisions and even the last auction too, as signs Nigeria is turning the corner. I'd like you to speak a little more on that.
Yeah, of course, I spoke about this I think on your program that I wasn't surprised with the 400 basis point rate hike. Of course, consensus based on Bloomberg is around 250 basis points. But when you look at the fact that there's been a pause on monetary policy meeting since the month of May. There was no meeting in July, there was no meeting in September, nor November. And January, we're supposed to have a meeting. We actually moved the meeting to February. And if you look at it politically, all the while, inflation has been on the uprise movement. And so it simply means that we've been folding our hands and we are now actually fighting inflation. So I feel that to show that we are really serious to actually fight this battle, I was preaching around the 500 basis point rate hike at a time when I saw the rate that naira was implementing. So seeing a 400 basis point, I think is actually reasonable. And also you also understand that the post-MPC meeting, the CBN governor also mentioned that the meeting for March will be more like evaluation, and if there's any reason further tightening, they will actually told that, and it makes a lot of sense because we'll actually see more of a credible impact between the last MPC and now. We'll see naira stabilize around 1,600 as we speak. Of course, based on the report that was released, it shows that from their perspective, like naira should be around 1,200 by the end of the year.
All right, so I guess we'll have that conversation, very close to the meeting. But look at this now. For me, if you ask me, I'll say this is a two-way street. And interestingly, even the MPC acknowledged the trade-off. However, isn't it also concerning that these same decisions have effectively withdrawn liquidity from the banking system? Talk about the last auction that we had, and I've heard some guys, some banking folks talk about the fact that that auction actually essentially mopped up cash from the banks. And I fear that this might affect their financial intermediation role, as some unethical banks might just keep, playing in the fixed income market rather than give credit to the real sector. I mean, I know you might want to talk about the LDR, but of course, anybody can decide to do anything. Let me get your thoughts on that.
Yeah, if you know before now, sincerely speaking, what the central bank just did was to regularize. Because they have opportunities to remove banks. Some banks were already at about 50% LDR at the time. So it wasn't systematic, it wasn't flat across board. But what the central bank just did, or what the MPC did, was to actually create a straight benchmark across board for all the banks. And I agree with you that will take a lot of liquidity from the banks. And what it will also mean is that actually granting loans to the real sector will actually be affected. I so much agree with that. But if you look at it critically, in a situation whereby you are fighting inflation, the first thing you want to take out is you want to take out consumption, and you want to actually push people from the area of consuming to the area of investing. I too also agree that current inflationary pressure is two-sided. We have the demand pull, we have the cost push aspect. And the demand pull aspect is the one that pertains to the monetary policy guide. And that's why they are currently focusing on it aggressively. And actually, it won't be effective when you actually take a rate up and at the same time you are leaving liquidity in the hand of banks. What it will mean is that you are giving room for banks to actually come into the security market and come and invest such funds. And what that will mean is that rates will automatically drop, and it means that you will be fighting consistently pushing rates up, while at the other hand, the banks will be using the liquidity to actually further depress rates. So in a time where you actually want rates to at least to a reasonable time be static at the level, you have to start the market of liquidity, and that's exactly what the central bank is currently doing.
Let me come in here, Oladipo. All right, I like how you've talked about, how it affects banks or the banking sector. What about the real sector, the ones who will be starved of, this credit? What about them? Aren't we, shouldn't we also be looking at balancing all of these? So on one front, we're doing something, maybe we have another, maybe the fiscal authority doing something else, on the other front. What are your thoughts on this?
Yeah, I think that's the angle where the target program now has to come to place. The central bank needs to do its bit. Maybe it's now have to be in the confines of the fiscal policy guide now to now target, create a target borrowing lending scheme to specific sectors. Because as we are currently, it's because we still have a country that where we are talking about growth and inflation. If we are not very careful, we'll get to a level where we'll have runaway inflation. And at that particular point,
how close are we to that point? How close are we to that point?
No, we are still far from the point, because currently, as we speak, we still have what we take, what we need to actually handle the current situation. And that's exactly one of the reasons why we are seeing the CBN governor becoming more hawkish and to actually rein in the current inflationary pressure. Imagine that we don't, the CBN governor didn't quickly standing in this situation, and naira has gotten to maybe 1,200 or 1,500 as we speak. You also know that there's also the effect of exchange rate that will filter into the inflationary pressure. So we need to actually first of all salvage the situation. And for me, at the beginning of the year, it was crystal clear. The CBN governor has mentioned it, that the H1 for the year will be hawkish. So it simply means that organizations, they should have been prepared for this. And it's just a matter of time, because I see by H2 we start seeing moderation. And by H2 I expect the MPC, I expect the central bank to start toning down on the current level of consciousness they are currently disposing in the market. So I agree with what the central bank is currently doing, because we need to study the country as we speak. And the ball is down in the court of the fiscal policy guy to find a way to create a scheme that will target some of these real sector players that they know that they have great impact to actually give to the market, and that's exactly what needs to be done.
All right, still looking at, the rate at which the CBN has been going to the domestic debt market. We might as well also probably begin to look at the crowding out of the private sector from the market, because when you look at the real rate returns, I mean, it's encouraging for us to have about 80% foreign participation in the last one we had. What are your thoughts about this? Are you worried? Is it something we should be worried about?
Yeah, I'm actually worried about that, as speaking, because it makes it more expensive for private companies to actually access the debt market, and that's why timing is also very essential for private organizations. You need to understand the architecture of the economy. You need to understand what will happen in the economy, because that gives you a very good opportunity to know the right time to come in. I feel that I'm sure I mentioned in one of my programs with you guys that January is a big window for any private organization that wants to go into the debt market. Because we know from February up to the maybe by the 7th month of the year, we expect the central bank and the monetary policy to actually show up a more aggressive policy that will impact the market, and that's exactly what we're currently seeing. So I think that this is a time for you to actually just get more like a short-dated borrowing to augment your book. It's not a time that you have to actually take a loan of 7-year or raise a 7-year debt or raise a 10-year debt. And this is more like you have to play more in the short market, like the commercial paper market, where you can actually raise funds of 270 days. So that at the end of the 270 days, you can roll into a cheaper funding for your business. Because as we speak, rates are actually very expensive in the market, because if government paper is already giving people close to about 27.3% level effective yield, of course, a lot of people will actually want like a 30% from a corporate organization.
All right, let's get back to the report. It talks about the ongoing monetization of the fiscal deficit, saying it contributed to an increase in inflation to 30%. That's 29.9% year on year as of January, as well as a sharp currency depreciation. I'd like to get your thoughts on that.
Please, can you come again? I can't hear clearly.
Okay, so I was talking about one of the things that this particular report said, saying that the ongoing monetization of the fiscal deficit contributed to the increase in inflation as well as a sharp currency depreciation. I would like to know if you agree with this particular statement.
Yeah, we all agree to this because several times analysts have come around to say the ways that means fund treated them actually contributed to where we are going. And I think that's one of the reasons why you've seen the central bank being more aggressive in actually taking liquidity from the market so as to actually reduce the impact of the current inflationary pressure in the market. And also, what that will do is that will also spare the current volatility in the exchange market, because it simply means that what you are doing is that you are making naira scarce so that naira can be purchased, and that's exactly what's happening. So they actually are totally wrong. Goldman Sachs, they are actually very right rather with their reports around that, because it's something that is very clear. Because when you print that kind of money into the system, of course, what you expect is exactly what we print. And funny enough, it's not peculiar in Nigeria. We saw that happen in the US as well. During the funds printed by the US during the COVID crisis, will actually work well. The inflationary pressure that they actually went through in 2023, and you saw how the US Fed, how they were very hawkish over time until when they start seeing results. And I think that's exactly what the current CBN government is currently doing. And that's why I mentioned that his focus, his policy will be inflation targeting. Because if you don't do that, you will continue to reduce the value of your currency.
All right, just before you go, the CBN is scheduled to hold a Treasury bills primary market auction today. What do you think investors will be looking at? What are we looking at in terms of rates?
I think currently both parties have shown their cards. We saw what happened at the last Omo auction. 1 year actually cleared at 21.5%, effective yield of over 27%. And also, just days later, the DMO through the central bank also replicated the same thing, where they closed the 1 year at 21.49%, almost the same effective yield. So for today, I think for what we'll likely see, we'll see that repeat as well, because it's already now looking like more like a window that's actually attracting foreign investors into the market, and I'm sure they want to maximize.
All right. So do you think 12 months is too long for the naira to appreciate to 1,200 per dollar? I mean, that was one of the top stories, or let's say the key highlight of this particular report. What are the catalysts that will spur this appreciation or even hinder it?
I think 12 months is too long. That they just gave you an on the horizon, and basically that's how it works. When you are given a projection, you give more like a 1 year window, and that's exactly what Goldman Sachs did. They gave you was like a window, but this is something that can actually happen within the space of 2 months, 3 months, or even less than that. It depends on the policies that currently.
And is it going to remain stable there? Is it going to be stable? Aren't we going to see another fluctuation?
Yeah, no, I think now, I think we'll see more stability than where we're at now. I think the next thing we'll start seeing is naira appreciating from where we are currently trading. Because one way is that we'll be seeing the influx of foreign investors in the market, and that's one of the things that can help us pushing the investment and help naira to actually appreciate.
All right, thank you so much, Oladipo Ajayi, Head Fixed Income and Forex, Chapel Hill Denham Securities. Thank you for sharing your thoughts with me today on Business Edge.
You're welcome. Thank you very much for having me.